And when it comes to preserving your hard-earned money, preserving your capital in the markets, I think it deserves a dedicated strategy, and that is the concept behind this particular video. I want to talk about capital preservation strategies. How to keep your money safe. After making the money, how do you keep it safe? Not making the money and then you end up losing it. So capital preservation investing is a strategy focused on protecting the principal amounts of an investment with minimal risk or loss. So in this case, we're talking about preserving your money, preserving your capital. This approach is popular, among conservative investors, retirees, or those approaching, a financial goal who prioritize maintaining their capital, over seeking higher returns. Their priority is to preserve their money. They won't entertain any level of losses. They just want to preserve their capital and possibly obtain, a decent level of returns on their money. So the strategies for capital preservation, include the key strategies here will include, high quality bonds. Talk about investing in high quality bonds, investing in governments or highly rated corporate bonds, which offer fixed interest payments with relatively low risk. Bonds that are rated triple Bs and above, high quality bonds, investment grade bonds that will not default, that will offer lower risk. Though the returns might be low, but at least the risk, is significantly minimal, if not, almost risk free. You have certificate of deposits. These are time deposits offered by banks with a fixed interest rate, and your principal is equally guaranteed. You have your principal and you equally have your fixed interest rate. It's somewhat, of a lower risk category. You equally have money market funds. Money market funds. These funds invest in short-term, high-quality investments, providing liquidity and stability with modest return. Your money is safe because they invest essentially on government instruments and bank, term deposits. They invest in CDs and other, safer investments. Not only that, you have treasury securities like the U.S. Treasury bills, the Nigerian government bonds. You equally have notes and bonds are considered among the safest investment you could think of because they are backed by the central government, they are backed by the federal governments. The government issue out these instruments as a means of borrowing, kind of borrowing money from the citizens, from investors, and they pay, regular coupons on the funds borrowed. So you have stable value funds. Stable value funds. These are commonly offered in retirement plans. These funds aim to preserve capital while providing stable returns. They provide stable returns. So let's look at the pros and the cons of these strategy of capital preservation strategies. Let's start with the advantages. Number one is low risk of losing your capital. There's minimal risk of losing your capital. Number two is there's this predictable, and stable returns. Your returns, are predictable and they are stable. There's liquidity in certain investments, allowing access to cash when needed. In other words, you can very easily turn your investment into cash. So there's that liquidity is provided. When it comes to disadvantages, number one here is lower returns compared to more aggressive investments. Of course, you're not there for the high returns, so you should be able to pocket or stomach or bear the lower returns you get from this kind of investing. There's inflation risk, as returns may not keep up with may not keep pace with rising costs. Your returns may not be able to keep pace with the high price of items in the economy, in the market. So there's limited growth potential, making it less suitable for long-term wealth building. The growth is very low because the returns, is quite minimal. And so if you compound that minimal return over time, it still will not really, it still may not be able to result into something quite substantial. The return is minimal, it's not much. So example use cases are retirement planning. Retirement planning. So near retirees may focus on capital preservation to ensure their savings last through, retirement. So they focus on these kind of investing because their capital is guaranteed and the returns are stable, the returns are kind of steady, although quite tiny, quite small compared to traditional kind of investing. There's these short-term goals. So it's ideal for savings for a near-term goal, such as you want to buy a house, you want to make down payment for a home, where the priority is to avoid losses. You tend to concentrate on loss avoidance than in even making higher returns. There's this sense meant for risk-averse investors, those who prioritize stability and safety, over potential high return, might favor capital preservation, strategy. It's a very important strategy actually, where essentially you just want to preserve your money, safety first, then returns will come in later. Safety over returns. All right. This strategy is good for those kind of individuals.